We're coming to you live from the SALT conference in New York City. Joining us for this segment, we have Joe Dowling, Global Head of Blackstone Alternative Asset Management. We're going to discuss the paradigm shift that we're seeing in the market. It's great to have you with us, Joe. Welcome to Trade Talks.
Thanks, Jill.
Sounds like a loaded question, but tell us what's happening in the market these days. How should companies be thinking about the paradigm shift that you see underway?
So fundamentally, we've moved from a quantitative easing environment to a quantitative tightening environment, and everyone knows that the Fed is taking out $95 billion of liquidity per month. That's $60 billion in treasuries and the balance in mortgage-backed securities. What this does is it takes liquidity out of the market. When you do that, things break. And what we saw, the first area that was affected were regional banks. And what we have now is a situation where credit is getting tighter. It's more expensive to get capital. And so I think in terms of corporations, it's really important to look at your maturity wall of your debt that's coming due and to be on top of refinancing that and also to try to take advantage of the opportunity to work on your relationships with your key banks. It's going to be more and more important.
Is that essentially what happened with the regional banks? They just weren't able to manage how these were coming due, and maybe what would you do, 500 basis points in 9 months?
So what that caused was a mismatch between the deposits, which, as we know, when you have the era of the cell phone, can just immediately be taken out of a bank in a nanosecond. A mismatch between those deposits and the assets. And the assets that the banks were holding were government securities, so long dated. So as interest rates rose, the price of those long dated securities were underwater. But we didn't have a situation where the collateral was bad. It was really a mismatch of maturity.
Yeah, well, I mean, not only being able to do transaction on a cell phone, we also didn't have social media in 2009 during the financial crisis, so
100%.
the news just traveled so much quicker. So given this market shift, how should investors be thinking about their portfolios?
Yeah, well, I think you ask yourself different questions in different market environments. And so we're probabilistic investors, so we never invest money with one economic scenario, sort of a view of one economic scenario. What we try to do is try to have balance in our portfolios. So the different questions you need to ask yourself now are, what if the equity markets don't go up? What's the yield on my portfolio? How much of my portfolio is dependent on multiple expansion or contraction? And those are very different questions than we had to ask during QE. In the QE environment, everything went up.
Right.
So it's a new paradigm.
Where are you seeing the biggest investment opportunities now?
By far, credit. You're getting equity-like returns in credit now. It's happened a few times in my career, and it's always been profitable to play. And there are lots of ways that you can do it. And this is actually an effect of QT, the QT world and the regional banks pulling back on liquidity. And you have a wall of maturities coming due. You have over $2 trillion of securities that were financed in a low interest rate environment. They're coming due and they will be refinanced. That is a huge opportunity for investors. Very bullish on credit.
So is it still early innings, or do investors still have an opportunity to get
Absolutely early innings.
All right, Joe, appreciate the insight. Thanks for joining us on Trade Talks.
Thank you
and
for
thanks
having
for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.